And so, viewers and listeners, thanks again for tuning in to Dollars and Making Sense. I misspoke last week. We were going to curtail events for the year, but gee, what an eventful last week we've had, Henry. It was just too much going on, and we had to come back and see if Henry's bet on Boris and a minority government was going to play through. But yeah, what a heck of a week we've had.
Yeah, backed by popular demand. Certainly the same goes for Boris. I think Jeremy Corbyn was always unelectable based on his grim personality, if nothing else. And if you're going to put forward a massive change agenda, and Bill Shorten did the same thing here, you've got to be popular. You've got to be charismatic. You've got to be a guy that can lead. And unfortunately he didn't. And I lost my bet, which is those are the kind of bets you want to lose. So those are hedging bets, emotional hedging as well as other ways of hedging. But certainly that was a bet that I was more than happy to lose.
I think one of the things you make a very valid comment, Henry, is that when we think back to 2001 and a GST coming in, I don't think there was any possibility that a Labor government could have brought that in. It was only John Howard that really could have brought that GST in on the back of a fairly strong win. It was highly misunderstood, but looking down the path, we all know it probably was the right way to go.
That's debatable, but anyway.
A broad-based consumption tax was very much favoured by Paul Keating for quite a while, but he got rolled by his own factions.
It was, but it was supposed to replace a whole heap of other taxes which still seem to be hanging around. So.
Well, that's the flip side of politicians making certain commitments. And, and before we came on air, you made comment that Boris's landslide victory, I mean, this is the biggest victory they've had since Thatcher, so there's going to be some possible unintended consequences of that as well.
There could well be, I guess. I suspect that if ScoMo tried to get through GST today, he would struggle. I don't think he's got the charisma or the leadership to do that. But certainly some of the unintended consequences from Boris getting in could be a whole fracturing of the United Kingdom. There's certainly a move from Scotland to have another independence vote, which was defeated last time, but certainly Nicola Sturgeon is again pushing for that. It's funny how the Scottish leaders are always named after fish. She's sturgeon, the last one was salmon. I don't know whether there's a theme there, but certainly if you're not named after a fish, then you've got no chance of being the leader of the SNP. But certainly Northern Ireland and Scotland both very much, I guess, in play to a certain extent. So it could end up being not United Kingdom or United Britain, but Little Britain at the end of all this. But we'll wait and see.
The number of very tawdry jokes that one could really bring forward. I think the UK comedians are going to have a field day when one thinks about it. But yes, there's much to be played out, and I can't read a commentary today that suggests that Boris will get his agenda done by 31 January. It's going to take quite a while.
Yeah, I mean, at the end of the day, 31 January is the day when they get divorced. They then have another year till December 2020 to negotiate the trade deals and anything else and the actual settlements and things. So this process is going to be going on for 5 years. Trade deals take years and years to negotiate. So, we're going to see this messing about from the UK for the next 3 to 5 years at least. It will be a generation defining issue, and generations are 20 years, and this will probably run for the best part of half a generation.
So I think that's a good segue to lead on to the next element of discussion that I wanted to raise with you in today's show. And that really comes about, it's nice to chat about this, but we're an investing program. And so I really want to pick your brains now with regards to how much impact this is really going to have on local investors, given a very parochial approach that many investors have here in Australia. And the notion that, there's been a lot of talk about a potential trade deal, for example, between Australia and the UK. But in the broader reality, and when you bring it down to brass tacks, what's that actually going to mean to investors here locally? Are all of a sudden a whole range of new opportunities going to come bounding around the corner because all of a sudden Boris is no longer attached to EU?
No, is the answer. I don't think it's got a lot of impact for us per se. It has some impact for some Australian companies that are listed here, mainly stocks like Janus Henderson, JHG is the code there, and for Virgin UK, which is the old Clydesdale, and many National Bank shareholders will still be shareholders of Clydesdale now by virtue Virgin UK. So it will have an impact on some specific stocks. But as far as a free trade deal goes, I mean, I think we've got a trade deal with the EU as well at the moment anyway. So it's not like the UK is not part of that deal. Trade deals take a long time to come to fruition. The benefits are marginal, to say the least. You need to have a really big kind of like a Trans-Pacific Partnership trade deal that makes a bit of a difference. But having tariffs in place and barriers is not a good thing. But the barriers between importing and exporting stuff out of the UK for us here in Australia are pretty minimal, I would imagine. So, I'm no expert on this, but
so let's focus on the main game, because really the main game for us is Asia. When we're talking about export markets, the biggest things that we do in this country are minerals, education, and tourism.
Yep.
Okay, so when we think about those three primary industries that we think about day by day, the focus and I guess the bigger impact decision during the course of this past week was the phase one of the trade deal, wouldn't you think?
Pork and beans. Yep. Detail is light, detail is scant, and at the end of the day, we have had 18 months of a trade war, and really and truly at the end of the day, it has pretty much achieved very little from both sides.
I read it was the equivalent of Donald Trump punching himself in the face.
Yes.
And now he's stopping punching himself in the face.
It's a bit like economic Afghanistan. You're there
that kind of attrition.
You're there for a long time with very little result, apart from just a lot of wounded and tragic deaths. So, I think the problem with this is that there's not a lot of detail for a start. There's no timetable for phase two. Yes, Trump won't be bringing in the new set of tariffs, but don't forget the old set of tariffs is still going to be there. The Chinese are not going to bring in some of their new tariffs, but again, some of the old tariffs are there. They're going to buy a lot more soybeans and a lot more pork, but their pigs have been decimated by African swine fever, so that was probably going to happen anyway. They have to get it from somewhere. And there's a lot of wishy-washy kind of stuff talking about intellectual property theft, and whatever. But to be honest, this is closing the door after the horse has bolted. The Chinese have been doing this for so long now. They are not having to steal our IP. We should be stealing theirs, because the world is bifurcating towards Chinese technology and US technology. Even Chinese companies are now being told they can't have US computers and technology in their offices, state-owned companies.
And what they say actually means something.
Yep. So, at best you could call this a draw. At worst, you could say the Chinese have actually held their ground and done okay. The good thing is the US economy hasn't suffered that greatly throughout all this. Sure, it's knocked a little bit off GDP, but the unemployment is still at very reduced levels. So the US economy is going pretty well. So maybe it's a deal that's enough to save some face, and the phase two is for another day, which will be after the election. They haven't even signed phase one.
So last week when we did the Australian Investors Association panel discussions, you shared the stage with another chief economist, investment officer from Stanford Brown, and I didn't find him overly forthcoming in his views and opinions, but thankfully you were, and from that perspective, for 2020 and the predictions, were there any key takeaways from that discussion that you could share with us today?
I guess 2020 is going to be an interesting year, because it could hold more volatility in terms of a presidential election year. We know how mercurial Donald Trump is, but the overriding factor, and we've talked about this before, is the Federal Reserve funds rate, which they are now pretty much on hold.
Yeah.
And that is enough to help equity markets globally. And with a trade deal done, even if it's light trade deal, even if it's whatever kind of trade deal, at least the words are good, that should instill some confidence. At least now we know for the time being until the next
There's
tweet
a certain
anyway.
amount of certainty.
There's certainty, and markets like certainty. Markets hate uncertain futures. So 2020 holds a lot more certainty. I would say it's pretty certain at the moment that Donald Trump will be re-elected. I can't see that being derailed by the Democrats. Hard as they try, there's 17 contenders for the nomination, none of which really stand out as fantastic, and all of which have got seemingly serious Achilles heels, whether it's Bernie Sanders and his health and his age, or Elizabeth Warren and her almost Corbyn-like tax and privatisation and health fund reforms. So it's going to be another interesting year, but I think you just have to focus on the fact that we are in for more of the same, with a Fed that is still going to keep rates on hold, and if anything, we may even see the Fed start talking about the dreaded rate rise at some stage, but it would be hard in an election year given the propensity of Trump.
Can you imagine? He'd go ballistic.
Yeah, but
he's screaming at him. But
four out of 17 board members at the last FOMC meeting were talking rate rises.
Wow. Well,
Trump's
screaming at him. Well, but again, for those of you that may tune in next week, we'll actually be presenting the audio and the video from the panel discussion that we did last week for the Investors Association. And during that particular panel, we did talk about interest rates and the likelihood. You and I are diametrically opposed right now. I believe they're going to go down here locally before too much more happens. And so I certainly, and again, today's announcement from the Treasurer that that the much vaunted surplus is not going to be as robust as they have been telling the population it's going to be. So I still think we're in for interesting times. I'm certainly looking forward to a bit of a break, but I don't think there's going to be much respite from the fact that the sales figures and the kind of sentiment that I'm reading in reports. I'll get to a bit later on in today's broadcast, but the indicators are still pointing towards a not so flash Christmas. Wage growth is stagnant. And so whilst the top end of town may be doing well with bonuses and executive pay, the poor old worker at this point in time, I don't think is doing all that well. And we'll see, I guess, in what the retail sales come out in February.
Yeah, I guess.
And I mean, you've talked last week about the bullishness of Black Friday and Cyber Monday. Whether that flows through all the way through to Christmas, when the retailers, Myer didn't help themselves on the weekend with an IT failure.
No.
That they're in enough strife already, and to close down their cash registers, I was just shaking my head, going, the poor old CEO there.
Did anyone notice? That's the question.
Well,
how long will they close before anyone noticed?
Yeah, funnily enough, I was thinking the same thing. Because of late, I keep on thinking you can fire a cannon down that particular store's departments, but who knows? Who knows? Anyway, let's roll on. We've already mentioned the fact that the Boris victory alleviated you of $50 of your wallet to Sportsbet, and thanks for that. In Beeksdownunder, which is Henry's daily, my apologies, Henry's daily missives. Again, I've read, I really like to see personalities coming through when you are evaluating companies. And having been part of Telstra over many years and following Telstra for many years, there was much discussion over that company, for example, when it was being led by the three amigos. And then after they all went back home, it was taken over by a guy called David Thodey. Now, Thodey made a real star of himself, I thought, when he looked after Telstra and did a pretty darn good job. Maybe not so much from an investor's perspective, but the people that worked for him certainly liked him a lot. And he's certainly still a star in amongst a lot of the government ranks. And I note now that Xero have just appointed him as the chairman. Do you think that'll have an impact on Xero's share price?
It's always good to see someone of David Thodey's caliber taking up the chairmanship of Xero, but really it's pretty much steady as she goes, I would imagine, for Xero. It's not a massive corporate change. Chairmen are a good steering person sometimes. Some
good salespeople maybe as well.
Good salespeople. They're good with governments and open a few doors, which I'm sure David Thodey will do. But but he's not an executive chairman, so his role is limited in that respect. So, but it's certainly a positive appointment.
Yeah, I must admit I read that, and again he's active in. I mean, he's just released the public service review as well. So
busy boy.
Yeah, he's very, very busy.
That went down well as well, didn't it?
Yeah, well, I think it was pretty well ignored. So they were going to do what they were going to do. I think the normal thing. It's yes, minister, that you never appoint a consultant unless you know what the result of the report's going to be in the first instance. Within your Beeksdownunder, also, you mentioned here Wang Yi, who is the Chinese foreign minister, criticised the US actions that have damaged ties between the two countries. And I read that and thought to myself, now who in the State Department or in the White House is going to give two bloody shits about that?
Well, there's that. I guess the relationship between the US and China is an important one, and going forward it's an important one. Clearly there has been some thawing in that relationship as far as the pragmatic issues about trade go, but certainly from a philosophical and political point of view they are still worlds apart, and the world is dividing into the Chinese corner and the US corner. The Chinese corner is not such a corner anymore because it is expanding corner through the belt, the one belt, one road policy that the Chinese have had. It's expanding dramatically into Africa, throughout Asia, and of course we've had our own expansion of Chinese influence in Australia here.
Absolutely.
And it's funny as America has withdrawn from the world stage in some respects. We've seen China fill that void, and the world will, at some stage, Australia has to, well, we have chosen, but it's very hard to keep our number one client happy, as well as our number one friend and ally happy. It's a very fine line, and sometimes the federal government and various other bodies fail to straddle that fine line appropriately, and it has consequences.
Thanks. Now, again, just finishing off our discussions of the last week's panel, we talked a lot in that panel about stimulus and about quantitative easing and printing money, etc. And you made a big point about how it's failed miserably. And again, you've highlighted in your Beeksdownunder, Japanese Tankan survey, lowest reading since March 2013. So much for stimulus and negative rates. And so, again, you make the point, Henry, that the pursuit of driving the rates down to zero or close to zero has had no impact in one of the biggest economies for 20 odd years. And so that's your argument of we really shouldn't be touching that interest rate lever next year at all.
It's pretty pointless for the RBA to cut rates, really, and we've talked about this at length, but the actual bang for the buck they will get would be minimal. The fact is the RBA is a institution that has power in name only. It's good for talking, it's good for presenting, and everyone seemingly listens to Phil Lowe, apart from the fact the banks don't, because the banks are the guys that set the mortgage rates and the deposit rates. It's not the RBA anymore. As far as Japan goes, and this goes for Europe as well, negative rates and stimulus have failed to work, and one of the biggest problems, and Anthony pointed this out at the presentation, Ashley, the presentation last week, was the lack of population growth. And Japan is a
stagnant
closed society with an ever-aging population.
They're actually decreasing.
Got to say, China is not dissimilar. They have got an aging demographic time bomb ticking away because of the one-child policy that they had. Europe has had a declining population and limited immigration, although there's plenty of people trying, and that has affected their growth. And if you look at our growth numbers that came out today with the MyEFO, and you take away immigration, our GDP growth is pretty much zero, and has been. And I know treasurer after treasurer has trumpeted the economic miracle that is Australia. The economic miracle that is Australia is primarily due to high levels of immigration driving consumption, driving house prices, driving the economy. Without that, economies do suffer big time. And that's Japan, that's Europe, that could be us. It certainly is. It could be China in years to come.
And that's another cause for discussion at another time. Whereas the thing that drives so much economic growth here locally tends to be an anathema for certainly many in the right of politics. Anyway, we move on. Disclaimer time.
Disclaimer time. Thanks for listening to Dollars and Making Sense, a weekly program about finance, money and investing. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. And if in doubt, contact an authorised licensed financial planner.
Thanks for that, Henry. As always, we give some counsel and thoughts, but if you are going to consider investing, please contact a professional and seek out that kind of advice. Also, something I mentioned at the beginning of the program, this is also a radio show about finance, investing and all matters money. We're broadcasting from Radio Northern Beaches on 88.7 and 90.3 megahertz on the FM band. We're podcast and streamed, and we're also here on YouTube. So don't forget, apparently there's a YouTube subscribe button down below that owl somewhere. Thanks to my producer that puts it there each week. Thank you, Mitchell. So please make sure that you subscribe there. The numbers are building slowly but steadily, so we appreciate the thoughts and feedback. And again, I would like to do a personal reach out to the one watcher who is still giving me a thumbs down at this point in time. Speak up. Would love to hear from you if you don't like it.
Maybe it's not you he's giving the thumbs down to, but me.
Oh, well, you know, there's a good-looking one, and there's Henry, but that's okay. He's got rid of his moustache now, so I got told to lay off the dad jokes as well, so no dad jokes this week. But anyway, look, please, we welcome feedback. We really enjoy that feedback, and we want to make this show as interesting as applicable to you, the investors that are out there, hopefully listening to us. Now, another big thing that we've been talking about in a number of weeks is Aramco, and they listed at about 1.7, 1.8 trillion valuation. They've just popped through the 2 trillion mark. And again, I simply raise this because it's of interest, but at the end of the day, it's of really no consequence to us mere mortals and everyday investors, is it?
I wouldn't say that actually. I would say that it has a consequence for us because this is the world's biggest company. It is Saudi Arabia's national oil company, which that is the important thing. And the listing of Aramco coincided with an OPEC meeting, and OPEC decided to make some rather more surprisingly large production cuts. Now that has helped the oil price. Anybody who's out there at the moment filling up their car will know that petrol is now $1.70 a litre, just in time for Christmas. Thanks, guys.
Isn't that every Christmas though? I'm sure just before the school holidays start, those prices at the Bowser start going up magically.
So although Aramco seems a world away, the fact that it's listed now that Saudi Arabia have a kind of a yardstick by the oil or their success and the oil price rather than just West Texas crude or Brent is interesting, and they obviously want to grow that valuation. And to grow that valuation, it's not going to be about exploration, it's not going to be about cost cutting, it is going to be about keeping and getting the oil price higher. And that does have implications for the Woodsides, the Santoses, the Oil Search, the Origins, the consumer sentiment, because if you're paying more for your petrol, you don't have as much to spend on other goods. So it is kind of, everything these days is connected to everything. And that certainly the fact that the oil price has perked up from $55 to $60 during the Aramco pricing and listing process is not exactly coincidence.
But could I also challenge some of those thoughts and suggest that this listing also is going to be challenging for Aramco, because over this next 5 to 10 years, we're going to potentially see the emergence of alternatives to coal, alternatives to fossil fuels. I mean, regardless of whether our own government believes in it or not, the world is changing. You made mention at the panel discussion, for example, that in Europe, EVs are huge. And for those that aren't aware, electric vehicles. I mean, this is a massive market that has not come close to this country yet. And I must admit, I was really dismayed that, you know, it turned to a political debate early this year when the Liberals very mischievously suggested Labor was trying to take the weekend away from people that owned SUVs because they were pushing an electric vehicle. I was horrified. I mean, it's just the daftest argument, but it seemed to carry sway Again, I think from that perspective, we're going to see a lot more of these companies emerging in the next 5 years. Wouldn't you agree?
Yeah, I think, oh God, yes, certainly we are. I mean, the German car industry has invested 45 billion US dollars in its car industry, converting it to electric vehicle focus. They've had massive problems with Dieselgate, that whole scandal involving diesel emissions.
Yeah.
And the German car industry has nailed its colours to the mast very firmly and said, okay, guys, the future is electric vehicles. This is very much a European thing. It is also a Chinese thing, although some of the subsidies in China have come off. But in Europe, the big manufacturers will, in the next 3 years, I think, will have a model lineup that goes to about 100 different models between the VWs, the Daimlers, the BMWs, the Mercedes, etc. You'll be able to choose 100 different models that are electric vehicles.
Well, Volvo's a big player in that space too.
And Volvo,
they're actually totally phasing out fossil fuels in their lineup. So that's a heck. But again, I'm curious because we're still talking, on a global scale. That's EU only. Do you see, electric vehicles becoming de rigueur, in South America and Africa as well?
Yeah, I think in time it will take longer in certain places because there will be a reluctance to embrace it. But when electric vehicles, when they're producing 100 models, the pricing point is going to come down dramatically. The problem with EVs is, especially here, it's a chicken and the egg scenario in that people won't buy an EV if they don't think they can make it to drive on their family holiday without a problem because they can't find a charger. In Germany, for instance, they've got 22,000 chargers at the moment. They're looking to increase that in the next couple of years up to 50,000 chargers. And Angela Merkel has a policy of being able to have 1 million charging points in Germany by 2030.
A million.
A million. So that changes the whole EV scale of things.
Makes it very real, doesn't it?
Here in Australia, if you wanted to drive your Tesla from here to Brisbane, you would have to plan appropriately for the stops. And the problem is that you're not the only one in your Tesla driving. So when you get to the stop to charge your car, there may be other cars already there, and there may be other cars already charging. So this is the ultimate chicken and the egg. And I'm sure when the car was first invented back in the beginning of the 19th, the end of the 19th century, beginning of the 20th century, were having the same arguments about horses are fantastic because they last forever. All you got to do is feed them every now and then, and there's feed all around. There's everything set up for feed, and why buy a car when there's no petrol stations to fill them up? But at some stage there is a tipping point.
There's a tipping point, yeah.
And poor old horse, those coaching inns turn into pubs, and they don't turn into overnight livery stables. And suddenly there's a Caltex outside every town. There's a Shell, there's a BP. It just takes a tipping point, and maybe in the next 2 or 3 years we will see that in Europe. And maybe I think it's a way off here though.
It's a funny thing. It just reminds me of a very funny line from a Danny DeVito movie, Other People's Money, where he stands up in front of shareholders and talks about buggy whip makers who, back in the day, they used to make the finest buggy whips on the planet, but, we don't do that anymore.
No.
And I think we've got to be thinking about the same thing. And viewers and listeners, I'd highlight this as a teaser for you to listen into next week's program, which features the panel discussion, simply because in the winners and losers from 2019 in Henry's stock listings, there were a couple of companies involved in lithium.
Yeah.
And so, given the fact that EVs are still they're not going to go away, and I agree with Henry that these are really the things of the future. That there is potential in lithium stocks, and so when we looked at those losing stocks, both the panelists were looking at those potentials, whether it was bad management or the like. But my keen interest really was, are there turnaround stories there that present really good buying opportunities? And Henry, maybe worthwhile going over a little bit of that ground that we tilled last week.
Yeah, there were a couple of lithium stocks in the dogs of 2019. Some things like Xero and Pilbara Minerals and Galaxy and Orocobre. The problem is that we have such short attention spans nowadays. Looking back at even as far back as the dot-com boom, we got so far ahead of ourselves that the internet was going to change the world overnight, and all these companies were going to make masses of money, and eyeballs were what counted, etc., etc. And the internet boom bust, and then it has taken 15 more years since for it to come to fruition. It wasn't long ago that cannabis was the big thing, and that was going to come out, and it was going to change medicine, it was going to change pain management, etc., etc. And guess what? Didn't happen as fast as investors and share prices were appreciating. So it crashed and it burnt. And the same thing happened with lithium, is that, when electric vehicles were first talked about and the Tesla came out, wow, isn't that cool? I want some exposure to the things that go into making the battery, lithium, cobalt, nickel, etc. They all went bananas.
Precious metals.
They all went absolutely bananas. And then, of course, it takes a lot longer for all this stuff to come to fruition. And so the supply came on stream to take advantage of this growing, in theory, demand, which didn't come through as fast as people thought. And the whole sector crashed. Now we're back to the stage where maybe we're starting to see the first signs that it's coming to fruition. In Europe, as these car manufacturers roll out these 100 models in the next couple of years. And when your BMWs and your Porsches, the new Taycan is an EV, it's an electric vehicle, doesn't go quite as far as they thought it would, but they'll solve that. So maybe the next 2 or 3 years it will happen, but it will probably be a slow burn as opposed to the flash in the pan that we see ever so often, and ever so often we see that that come to not nothing, because it does eventually happen, but we just get ahead of ourselves.
But I might highlight as well to the viewers and listeners that as an ex-financial planner myself, when we do our training and you listen and read the good books around financial planning, every one of them will tell you that stock and equities are a 5 to 7 year window. Yet so many people that get in the stock market don't think 5 to 7 years. They think it's just around the corner, aren't they?
Well, they are. I mean, the problem is that most advisors tell you they're 5 to 7 year investments only because they hope that they've retired by the time it all goes horribly wrong, and they have to actually face the investment.
They won't be around to face that.
They won't be around, or they've moved on to a different company, or people will have forgotten. And that's one of the reasons why.
There's a certain element of truth in that.
That's one of the reasons why people always talk about it's a long-term investment. Well, it may well be, but
so you still like to keep above water now and then, right?
I think investing these days, it has changed in that there's a lot more active managers out there. There's a lot more passive money out there as well. But certainly, if you're looking after your own money, you do need to be vigilant, and you do need to. They're not buy, hold, set and forget anymore. Just doing that is okay. You might pick a CSL, you might pick whatever, but you might pick a Westpac, you might pick
an AMP.
You might pick an AMP, you might pick whatever. Buy and hold is really not a great strategy anymore. It may be that you still hold them after you've bought them, but you've got to keep looking at the reasons why you're holding. You've got to look at the reasons why you're holding them.
One of the things that I was discussing with Henry before we came on air, listeners and viewers, is that I've been reading a little bit of scuttlebutt around AMP and some of the media companies and dividends. And so because many investors that I encounter are all about dividends, they want to see those franked dividends and the like. And so, there's a lot of scuttlebutt going around, with regards to AMP cutting their dividend. Certainly media companies are looking very sick these days for obvious reasons around, being replaced by the internet or just simply being, forgotten about. So again, I think it's well worth, the salient lesson is buy, hold, yes, but keep monitoring. Don't go to sleep. That wonderful term, money never sleeps. It's absolutely true. Absolutely true. And is active investors, just by the simple fact that you're listening and watching this show, ladies and gentlemen, means that you've at least got an interest in what you and your money is doing. But it's absolutely true. Money never sleeps, does it?
Well, you consider that this iPhone, how old's that?
Oh gosh,
11
that's
years?
10, 11, yeah. That's
11, 12 years?
That was a relic.
Facebook, Google, all these companies haven't been around that long. If you want to set and forget, the world will change in the next decade, that is for sure. AI and EVs, artificial intelligent electric vehicles, gene therapy, nanotechnology.
Cool.
It's a fast
Really
world.
exciting stuff. And I guess to round out this week's video on dollars making sense, we're going to talk a little bit about the dollars making sense portfolio. I've been posting this on my weekly blog at otgcapital.com.au. Henry, very pleased to say that your grab bag of stocks is now riding at about plus 7.18%. Again, mostly green, bit of red in there as well. And again, just before we close out for the year, I will be posting some updates during the silly season and sand in feet time between now when we come back after Australia Day. But are there any changes in there? You know, Zip, Xero, Macquarie, Chimix, Preamium, that's Magellan, etc. Any?
Not really. I mean, the market's once again heading towards an all-time high. We're up, when I left the office, up around 84 points out of a US market that was zip. So that's a pretty good result. It does seem as if Santa has come early, at least in Australia. We are ahead of everybody else, so maybe we're just predicting what everyone else is doing. But there is some extreme volatility at the moment, and that is not necessarily a good thing, but you can take advantage of that. This is the silly season, and it's not called the silly season for nothing. And as a result, a lot of fund managers have ruled off their books. A lot of fund managers have stopped trading. A lot of fund managers will be enjoying broker largesse and going out for lunches and doing the corporate circuit, which, having done it many years ago, is quite prolific, despite appearances. So you do get some extraordinary moves. For instance, Preamium, which I think is one of the ones in the red on that list, is actually up 7% when I left the office this morning on absolutely nothing. There's another stock, Points Bet, that we've talked about in terms of US sports gaming. That was down 10% one day and up 10% the next day. So when volumes thin out and fund managers go to the beach and start doing their Christmas shopping and nipping off from the office, things do get a little silly. And we do also see stocks that perform very well during the year. They may lock in those profits, lock in that performance, and try and what we call window dress some of the stocks that haven't performed so well. So they just try and tickle those prices up so that their performance in their relative portfolios doesn't look so bad for the year end, because
that's when they close their books off and then give their yield.
Well, I mean, usually
that's a marketing exercise.
Yeah, it's a marketing thing. So I mean, usually they tend to go financial years, but you know, we tend to focus on big events. New Year and Christmas, etc., is a big event for humans, at least for Christian humans. So it's something that fund managers do focus on, so that they can say for calendar year 2019 our performance was 12%, and all they do is then market the billio out of that for the next year and try and get more money in the tin.
You got it. Okay, so ladies and gents, that's a wrap for this week for Dollars and Making Sense. Again, our sincere thanks for those that have listened in and joined us in our inaugural few broadcasts, and as our audience starts to build. Please, if you like what you are seeing and hearing, please recommend it to your friends. And again, I keep reaching out to our down thumber on YouTube. Reach out, let me know. We'd love to hear from you and maybe fix what's getting under your goat. But Henry, thanks so kindly for joining us at the microphone, Pleasure. At the card table, as I so lovingly call this particular part of the world. And that's a wrap. Season's greetings to you all. And until Australia Day, that's a wrap.
Stay safe.